Hello and welcome to Fridays with Vistage. My name is Bill Black. I'm a Vistage member and the founder and host of ExitCoachRadio.com, and I'm your moderator for today's session. Our topic today is how to get the right financial reports for your business. AccountingDepartment.com co-founder Dennis M. Najjar, CPA, CGMA, will set up and walk through the monthly financial reports for a mock professional services company. You're going to learn what you're missing in your monthly reports and how to fix it. There'll also be an emphasis on how to understand which KPIs really matter for you and how to read your monthly financial report package. Dennis Najjar has worked in public accounting since 1982. After graduating from Rutgers University in 1982, Dennis joined Coopers & Lybrand. In 1986, Dennis started the public accounting firm Dennis M. Najjar, CPA. Throughout his career, Dennis has worked exclusively with small, medium, and startup businesses, giving him the knowledge and experience to oversee the AccountingDepartment.com team in helping clients with strategic business planning for future success and growth. You'll find his articles in Entrepreneur Magazine and on About.com's accounting channel, where Dennis is the sole contributor of thought leadership and accounting guidance to business owners and CEOs. Ladies and gentlemen, Dennis Najjar.
Thank you, Bill. Well, I'm really excited to be here today and to help our business owners and our Vistage family get a little bit more knowledgeable about how to use their financial reports, especially in helping them understand KPIs and develop them for their businesses. So without further ado, let's just jump right into it and talk first a little bit about what are the problems. Well, we all know that we don't know what we don't know. I mean, it doesn't matter what industry you're in. It's a universal concern. You know, when you're sort of left grasping for what is the way to approach something, you're often confused and amiss. So let's start out by talking about the fact that you do need a very well put together financial report package. That's going to be the key to getting information in front of you, helping you develop the KPIs for your business so that you can take some control back and begin to manage the affairs of your company. Do you know what reports to ask for? Often another common problem. So we're going to help you identify today some of the key things that you can be asking for that will help put these financial reports together, the KPIs as well. And then, of course, looking at them and understanding some of the questions that you need to ask so that you can be in a good position to interpret their results. So those are our universal challenges. We call them problems, but I'd like to call them challenges a little bit more often. So what do we want to get out of this today? First of all, we'll talk about that very exciting topic, method of accounting. To me, it's the top of the hit list. It starts every conversation because it affects everything that happens from this point forward. Then we're going to integrate into this conversation both the financial and the non-financial information that you're going to need to be able to perform to do the calculations on these KPIs. We're going to talk about several KPIs, like we got 4 that we're going to drill down into and walk you through the mechanics of how to construct them and how to interpret them. And this is only the starting point. This is not the answer for everyone, but this is a orientation on how you can then apply the same principles within your own organization. And the end goal, of course, would be to end that problem of just having some made-up numbers that we're making decisions off of. All right, so let's start with the basics. Most business owners have heard of cash and accrual accounting. And, you know, when they hear the word accrual, they cringe. They think accrual and accounting or accountants, it's something that they love to do, that it's their thing and they're just trying to impose it on you as the business owner. There's actually 3 kinds of reports that are available. Most businesses don't really use cash. Cash basis is truly for an organization that is a retail operation where there is no receivables. There are very few payables, not to mention that there wouldn't be payables in most businesses. The most common format for financial reports is really what's called the modified cash method of accounting. And what that means is that the modified method includes accounts receivables and accounts payable. So when you send out an invoice, that's when it shows up on your P&L. When you put a bill in your accounts payable, that's when it shows up in your P&L. And that basis, while it is a step up from a cash method of accounting, it's sort of a rudimentary format for your accounting. And here's why. Because what it doesn't do is it doesn't match things. If you get paid in advance for the services you perform, a retainer, a deposit, and you put that on the P&L, the services haven't been incurred, the expenses haven't been incurred, you're not matching the revenue with the expenses. When you prepay something, let's say you pay a year's worth of insurance in advance, while that is an expense, of course, it doesn't properly reflect out throughout the 12 months of the business cycle for which that expense applies to. So the accrual method of accounting has one mission and one mission only, and that mission is to match. It's to match revenue with expenses, to put them both on the P&L at the same time. So when you're looking at the numbers, they actually will be meaningful. They will actually begin to tell a story. Now the story, as the story goes, begins way before you even construct or have a transaction on your accrual basis financial reports. It actually begins with a well-designed chart of accounts. Now, I love to tell this story because I'm an accountant, I'm a CPA, I'm proud of it. It's my baggage I have to deal with, and my rut in life, as they say. And the story I love to tell is early in my career, when I used to talk to clients about setting up a chart of accounts, and I would talk to them about using account numbers, the facial expressions would just be, they're just memorable because they just cringed at the idea of using account numbers. They thought it was an accountant's thing. Back to the accountant wanted it. And I actually didn't realize the significance of it early on in my career. I will be honest about that. But within the last 5 years maybe, I've really come to understand in a way that I can communicate it to business owners the significance of numbering your accounts in your chart of account. The significance is very simple. It enables you to tell a story. You know, if you look at your chart of accounts now and you're not using numbers, I can guarantee you something. And I will be also very upfront. Accountants don't make very many guarantees, but we like to make the safe ones. So I'm going to make a safe one. And that guarantee is if you're not using accounts, your chart of accounts is alphabetical. You got advertising, followed by bank charges, followed by commissions, followed by depreciation, and it's just alphabetical. Because unless you tell your software something different, its next line of defense is just to put them in alphabetical order. And the problem with that is it doesn't tell a story. And so what I like to say is that your chart of accounts should enable you to tell a story, to be able to read your financials, and it groups things together. You've got all your employment-related expenses grouped together in subtotals. You have all your cost of services or cost of goods sold accounts grouped together in the right place on the P&L. And this is accomplished by a chart of accounts. Same thing applies to the balance sheet. We want to make sure that accumulated depreciation is not before fixed assets because A comes before F. It's a presentation thing, and that's what I think most people thought of when accountants were saying it. But the truth of it is that it helps tell the story. So we want to really focus on two things when you're looking at your financials. Do you have a story to tell? Do you have a well-organized chart of accounts that puts things in the right places? And are you tracking your operations on the accrual method? Are you deferring revenue when you get paid in advance? Are you accruing revenue when you've done work but haven't invoiced it? Are you accruing payroll? All of these things are so important to being able to look at the numbers and draw some conclusions. And without that, your KPIs are actually going to be meaningless. So unless you're committed to accrual financial reports, you might as well not even listen to the rest of this conversation. Because while it'll be a good exercise in academics, you won't be able to utilize the information. You can do the calculations, but they'll be all over the place, and they won't really yield you anything meaningful that will help you with your business. So these KPIs are not to be utilized in a vacuum. Right? They will work with each other. No one stands on its own. As we walk through the example that I've put together, what we're going to find is that you have to look at them together, in relationship with each other. Now, we think most of the time accounting is a science. 2 plus 2 equals 4, assets minus liabilities equals equity. And while there's some truth in that, and accountants don't generally like to admit that they're artistes or artists, I will tell you that there is an art component to interpreting these KPIs. So it's an art and a science. We're going to walk through the mathematics of it. That's the science part of it. The art is that interpretation, that interrelationship between the different KPIs, because each one individually is not in and of itself all the information that you're going to need. All right? So those are some important high-level things to be aware of before we get into our actual case study. All right, so case study we put together. Here's some demographics of that company. It's an architectural firm, so it's services. There's no product, there's no inventory, there's no manufacturing. The revenue, they're between $10 and $15 million on a good year. On a not so good year, they're down at the lower end of the range. They have 45 employees in their company, and they work in 2 primary areas of specialty, residential and commercial projects. They use both employees and outside consultants, 1099 contractors, and they're split between fixed-fee projects and time and material projects. So a pretty good sampling of diversity within that sample company that we've put together here. Now, we've identified 4 KPIs for this particular company, and I'm going to keep emphasizing that because one of the things that is sort of a mystery about KPIs is that it's not like accounting. It's not like assets minus liabilities equals equity, and you can go look that up a book, and that's what you need to know. These are very unique to every business, to every industry. What's important to one manager is not going to be important to another manager. What is important is that you find the ones that are going to benefit you in managing your company. Well, of course, it all starts with that accurate set of financial reports on an accrual basis. But once you define that, then you're off and running. So here we're going to go through 4 different ones. Feel free to use them in your own organization. These are nothing proprietary. These are real life, and these are ones that our sample company does use. All right. So let's get into our KPI number 1. Now, this one is called annual revenue per billable consultant. Now, I set this up. I've laid this out in the what, why, where, when type format. Makes it very easy to follow. There'll be some action steps after each one, and you'll have your plan moving forward. So what is our what here? What's the definition of this particular KPI? It is to calculate the annual revenue per consultant. Now, here, I want to make sure we're clear on this. As I mentioned in the company demographics, the sample company has both employees and outside consultants who work on their projects. The term consultant here is intended to mean the employees of the company. As you'll see in a moment, I'm going to show you what we're going to do with the outside consultants and why we're doing this. So it's important, again, you're starting to understand the information you're working with and not just trying to run through a math calculation. All right? So we're going to be calculating annual revenue per consultant. Why are we doing this? This will help us measure the productivity of each consultant, each billable person within our company, and what they're contributing to our gross profit, our revenues. What are we going to need for this? Well, we're going to need the P&L, obviously. We'll want that P&L to be on accrual. It's going to have that deferred revenue, possibly some accrued revenue in there. We've got to have that payroll cost captured to match that revenue. All of that needs to be in our financials. You need to reach out to your HR department, and you need to find out the number of full-time equivalent consultants you have on your staff. So that's something that's one of those pieces of non-financial data that you're going to need to have in working with these KPIs. And then you're going to need to have your P&L laid out, the story, in such a way that you can extract key information. And we're going to look at the pieces of labor that make up the fully loaded costs in this calculation. The frequency when you're going to want to do this, I would recommend monthly. That's the best way and best time frame to be looking at this. Although if your reports are not going to be on the accrual method every month, but maybe you just do that once a year for a review or an audit, or even just for your tax return, if that's applicable to you, then you do this on a yearly basis. As I can't overemphasize it, if your books are not on that accrual method, this is going to yield wild results that will not be meaningful to you. All right, so we have here a lot of information. I want to break this down. I want to help you digest it and walk through this. It's important to understand the art behind the science that we're going to go through. So we have, across the top, we've got 4 months. 4 months of P&L information that we're going to be analyzing, June through September. In our rows, we have our revenue. We have our revenue broken down by the main categories we talked about, plus some other areas. And then you'll notice something that's not going to be on your P&L. This is where you're going to actually be taking this data, putting it into Excel, and then massaging it, turning it into that art from that science part. And the first thing we're going to do is we're going to back out the revenue that our consultants are generating, our 1099 consultants. Now, the reason why we're doing this, and again, applicability, everybody's going to be different, but in this sample company, these consultants are used, first of all, they're not on payroll, so this is not measurable in terms of our KPI. Number two, they don't work full-time, right? We have some specialty that we need a consultant for. We bring them in, or the client brings them in, and they do that piece of the work, and off they go. So without subtracting that revenue that's not generated by our own internal employees, we're not going to have an accurate calculation here. So we're backing that out for the consultants' revenue that they generate. Then below that, we have our cost of services section, and you can see we've got our wages, taxes, benefits, all very important pieces. And then we've got that consultant. This is what we're paying those consultants for that revenue that they generated. And again, we want to subtract that out. So we're massaging the information to get it to a state where we can begin to do our calculation. Then after that, we have to bring into the fold the general and administrative wages and payroll tax expenses for our employee consultants. Now, this is a holistic calculation here. Our preference, our recommendation, many of our clients will do it this way, is they're going to bifurcate. They're going to split their wages for their consultants between the cost of goods sold section, cost of services section in their P&L, and their general and administrative section. They're trying to capture the actual time spent on the projects in their gross profit calculation, and of course the non-billable time, such as vacation and holidays, so forth and so on, they want that to be below the line. And so we have to bring that into the picture if we're trying to analyze the annual revenue per billable consultant. So we're going to add that in. Now we just get some simple math formulas in the picture here, and you can see we have our revenue. We brought that down from up top. We got our HR to tell us we have 36 full-time employees, full-time equivalent employees who are in the field providing the consulting services. And that translates into a revenue per billable employee of about $19,000 in the month of June, 16, 14, and another 19 all the way out in September. The next part is to grab the cost. So we're going to take using June as an example, the 207, we're going to add that to the 19,000 in the G&A related expenses, and we end up with that 226, 227 number. Again, divide that by our number of employees, and we come up with a cost per billable employee in the month of June of just under $6,300. Now our actual calculation, our KPI, what we're going to be looking at and monitoring and investigating when it doesn't hit our target is the last three rows. So we take the calculation of our revenue per employee, we divide it by our cost per employee, these are the consultant employees, and we arrive at our multiplier. So in the month of June, we hit 3. It's 2.66 in July, 2.6 in August, and then we get a bump back up in September to 3. So well, what does that mean? Now what do I do with it? Well, our client has established, our sample company here, has established that they're looking for a multiple of 3. That's their benchmark. They're looking to see that whatever it costs for that employee, all in, the benefits, the non-billable time, the billable time, that it hits 3 times in revenue each month. So you can see that in 2 of the 4 months we have here, we have hit, or they have hit their goal of 3 times. But in 2 of the months, they didn't. Now, that becomes the starting point to understand why. It doesn't mean all hell's going to, everything's going to hell in a handbasket, as the expression goes, but it does mean that some investigation has to incur. Over on the right, there's a lot of notes here, and I purposely put these in so you'd have something to refer back to later on. Just having this chart might not be enough to jog your memory on some of the things to think about. But at a high level, you can see I'm reiterating the importance of properly recorded revenue. Right, we're capturing all the payroll and related payroll for the staff that does the production. I throw in there again, we want to make sure payroll is properly accrued. That's important to make sure you have the total true cost in your numbers. And then there's other things you can think about, whether, for example, if in our client's case / sample company, they have their principals required to do so much billable time a month. And so we need to convert that to a full-time equivalent. So if your managing principals are managers 100%, then they don't work into the calculation. But if it turns out that they are doing some level of the work themselves, you don't want to throw them in at a one-for-one value if, for example, they're only required to produce 20%, or maybe they're required to produce a billable time equal to 50% of their hours. Then you would need to adjust that. So things to think about. Then, of course, what really happened in July and August? Well, there's a number of things that happened, or could have potentially happened. One is, when we specifically pick these months, not because it's this time of the year, but because it's a very common time for vacations and holidays. And that's actually going to have an impact on your number. The more non-billable time your billable consultants have, the lower your multiple is going to be. So there's one example of what would happen. So what you'd want to do is drill into that a little bit further and understand, is there something wrong with our ratio, or is it just a function of something like vacation and holiday? Another example is the last text box in the lower right-hand corner where we talk about new staff. They're not always as productive. So if you had brought on some new staff, you would expect a period of time where their billable activities would not be at the level you would be looking for. So this is company-wide. That's the purpose of this, company-wide. All right? So action steps, they're very much going to follow in line with the information that you gathered. So you've got to get that revenue information. You've got to look at get the payroll data, all the payroll costs that go with it. You need that number of employees. Of course, you do the calculation, and then most importantly, what? You set up a process for a regular and timely calculation of this KPI. That's a task you can delegate, and then you review and you analyze. You monitor what's going on with the business. All right, KPI number 2 that we want to drill into here is annual revenue per employee. Now, this may sound the same, but there is a difference, and that difference is this is truly for all the employees in the company, right? So what is that composition? Well, there's administrative people that are in every company. You've got marketing, you've got HR, you've got admin support. I mean, those are all part of the team. Their role is not to be billable, but they are part of the cost of the organization. And so here you're looking for a similar matrix. We're going to walk through the calculation in a moment, but we're going to be looking at that annual revenue per employee. We'll again exclude the 1099 consultants, get them out of the picture, and what will this be telling us is overall what is our organizational effectiveness or efficiency in terms of the costs that we incur to the revenue that we generate. We'll need the same information that we talked about before, except it'll be total number of employees. All right, same grid of information, right? So we've got our 4 months, we've got our revenue, our costs, we've got more down here under expenses now because we've added in our labor for our administrative teams. We've got their benefits included, and of course we're going to have a bit more in the way of taxes. But we have the basics are still the same. We're going to subtract out the consultant's revenue, subtract out the consultant's cost, arrive at our net productivity dollars, revenue, as well as costs. We go down to the bottom half, and we, again, have the same row of information. This is not going to change. The only number that's changing here is our number of employees, and we're calculating our revenue per billable employee, 15, 13, 11, 9, and then 15 again. And then we're summarizing our fully loaded cost for labor. Same formulas above, the 207 plus the 120. Now we're dividing it by 45, and we're coming up with our cost per employee. Our KPI is to take that revenue per employee and divide it by cost per employee and come up with our multiplier. Now, in our sample company, we're targeting 2 times here. So what we're saying is we're spreading the cost of the administrative part of our business out, and that's going to dilute our KPI down from 3 down to 2. Now, these numbers are totally what you want them to be. There's no right or wrong. There's no book to look them up in. There are standards for different professions, different specialties within any line of business. But for this purpose, this particular sample company has decided they want that to be a multiple of 2. And so what you find here again is June and September hit their numbers. July and August did not, and there's going to be similar reasons. Those reasons on the previous KPI slide are going to all apply here. So you need to drill into that and understand what's causing that to go down, and is there any corrective actions that need to take place. Action steps, same information. Gather the income, gather the cost, get that FTEs for all employees, calculate, set up a process for regular timely reporting of this information, calculation of it, and the review and the analysis is your responsibility. All right, billable utilization, KPI number 3, billable utilization. Here what we want to take a look at is our billable hours to our total hours, our available hours for a particular work week. This is going to measure the hours that are billed out as a percentage of the total hours. Now, again, every company is going to have a target for what they want that number to be. This is primarily driven by non-financial information. You're going to need data on hours. You're going to need billable hours, your non-billable time. You might have that broken down by a couple of different categories because there are several ways to look at this. Again, no right, no wrong. You have to decide which one is going to work best for you. And once you select that, then it's important, of course, to be consistent with that so that you're able to compare results period over period. So what are the options for the definition of available hours? Well, I came up with 4. One would be, the traditional 20/80. 52 times 40, it's 20/80. So that's one unit of measure that you could utilize. You could also decide that you want to utilize the 20/80 less holidays. That might be a standard under which you want to apply. A third option could be 20/80 less holidays and personal days, vacation days, those sorts of non-billable times. And then, of course, there's always the option to pick an arbitrary number that you're expecting everybody to hit in terms of their, available hours that they will have worked for. That implies, of course, that there's, some sort of overtime that everyone is expected to put in. Not necessarily compensated overtime because most of these positions are salary, So you're looking at that sort of a denomination. Now, the one thing you might notice is missing from those examples is admin time. And, you're going to want to look at that separately, and here's the reason why. Administrative time might be a requirement for your business. I mean, it's one thing to say you're going out and you're doing, you got the literal time on the client, but there's often some behind-the-scenes admin time that has to be incurred. And you may or may not want that to be excluded from your calculation. I'm going to show you a couple of different examples in a moment. Again, no one is right or wrong. It's the one that works for you and the one that you want to apply consistently period after period in terms of measuring this. Once you start changing, of course, then you have to go back and you have to alter the previous periods to make the information comparable. All right, so here we're going to be looking at it on an employee-by-employee basis. So this will be something that your accounting personnel, maybe HR to some extent, will be putting together these hours information. So this is totally off balance sheet, off P&L. It's coming from other sources. So we have Sally Smith here, and what we have here is her timesheet for the month of July. She booked 170 hours for the month. She broke it down between her holiday, 4th of July. She took off looks like almost a full day, some personal. She did have some of that admin time I was just referring to, and then she squeezed in a couple of vacation days. She also worked on 4 different projects, and these are the hours that she invested in each one of those 4 different projects. Below that, we are going to look at example 1 is we're excluding holiday, personal, and vacation from the available hours. So the calculation, pretty straightforward. Her billable time is the sum of phases 1, 3, 4, and 5. That came out to 139. Her theoretical hours, or available hours, would be number of work days. It's somewhere between 19 and 21. I think 1 or 2 months has 22 days. So this is an actual days calculation for each month. Times the standard of 8 hours. So in this case, July had 21 working days, 8 hours a day. 168 is her quote-unquote available hours. And then this measurement tool is excluding those, actually all of the items are being excluded here from holiday right down through vacation. And so you end up with 137 hours available net of those non-billable time. The calculation is A divided by B, and what you find is that the billable utilization is over 100%, that this Sally billed out more than 100% of her available time in this particular month once you back out the non-billable stuff. Example 2 is we're going to include holiday, personal, vacation in the available hours. So again, we start out with the summation of the billable time, phases 1 through 5, came out to that 139 again. The available hours, there's no adjustment, so it's the 168. And then the utilization here is the 83%, meaning that 83% of the time she was working was billable on various client projects. Now, whether or not that's a good number is going to be a function of your KPI. If your magic number is you're looking for 80% billable time from your staff, all hours that they put in except for their admin time, and that's what you see up here, the admin, that's the difference. It's the admin time, then she would be right within that target. All right. Again, I've provided several different notes as points of reference to help you when you want to go back and look at this and understand the calculations. They're there for you to pick and choose what works for you. The second example, Sam Smith, no relation. This happened to be Smith, same last name. Here for Sam, we have his hours captured for the month of July as well. And we've got his non-billable. He worked on 3 different projects. He came in with a total of 223 hours. We do the similar calculations. We're backing out his holiday, personal, and vacation, and we come up with his utilization of $128,000 based on this formula. And this is comparable to Sally. This one here is comparable to Sally as well. He came in at 96%. And I want to stop and just mention the comparison between the two. Now, interestingly enough, you might have thought initially that Sam is doing a better job putting in more effort than Sally was because his numbers are higher. That might not actually be the case. The truth of the matter might be Sam is putting a lot more time in, but he's going over budget on the projects. So a higher number doesn't always mean better. So if you're so when you set your standard, if it was 100%, or in the case of the example 2, if it was 80% and he's putting in 97, that should be a red flag. Because if your standard is accurately calculated to be 80, of course you would know to question it if the guy or the gal came in at 65 or 70 or something below that. You'd find that unacceptable and you'd want to know why. You can't just dismiss an employee who comes in above, because that might be it might be a sign of some other issues. Could be a sign of burnout. He's just putting in way too much time, and you can only sustain that sort of level of overtime for so long before it affects your work and your overall productivity. Could be, as I mentioned a moment ago, that he's actually spending more time than you had budgeted for, and therefore you're not going to see the profit on that account at the end of the day when you finalize the project and you look back at it. You'll see that it worked out in excess. Could be as a newer employee. That's, again, we go back to that example, and so there's that learning curve that might go into it. So you do have to look at it. Whatever your norm is, whatever you set your KPI to be, you have to look at the exceptions that go both ways. That's the analysis part. And just what does that mean for 1 second? That analysis part means asking questions. Doesn't mean you need to know the answer. You need to know the questions. What do we start this whole conversation with? You don't know what you don't know, right? So what we're trying to do here is get you into a position where you are able to ask questions, and people within your organization can give you the information that can then enable you to draw the conclusions that instinctively you're trying to get to. You're just not in a position to articulate that up front. So our data gathering is consistent. It is hours driven in this case that you're pulling it all together. The calculation steps are detailed out, and then of course you've got that regular and timely reporting, the review and analysis. Now I wanted to stop at one of these slides and just focus in on this last comment of set up a process for regular and timely. The thing that happens, and I see it because I'm an accountant, of course, that there's no secret there. But what I can see immediately when I talk to somebody, a business owner, is that often they're not creating accountability. Again, you go back to that very first slide, and when you put yourself in a position of not knowing what you don't know, that means you want to delegate. And actually delegating will probably not be the best answer to that situation. Because when you turn something over to someone else totally and don't create accountability back to you, then you basically have given that person the keys to the kingdom. I like to call it the 2-week rule. And in every presentation I give, I always make a point of talking about what happens within the first 2 weeks of you bringing in a person in your finance department, whether that be a bookkeeper, an accountant, a controller, a CFO, whatever it might be. It doesn't matter the level. Within 2 weeks, that individual is going to know everything you know, everything you don't know, everything you ask, and everything you don't ask. And that is the tipping point right there. Because most of the time our answer to the problem is to delegate. But without that second step of accountability, you've basically handed it over to somebody else. And it's often not a good thing, by the way, because what it means is, since they know what you're going to ask and what you're not going to ask, why would I do things that I know I should do, but you never asked for? Why should I give you things that you never asked for, even though I know you should be having them? There's no accountability. So this process that I'm referring to is one word. It's accountability. It's setting up a process where you define what you need, you lay it out. These calculations, for the most part, can be done by somebody else. These are not things that need to be done by you. And then the expectation / the accountability is that those analysis, the KPIs, the monthly financial reports, all of this is provided to you. Now, the flip side to the three-sided coin that I'm talking about here, because it goes back in another direction, is if you don't get it, you need to find out why. You need to create that accountability, right? So all of this is centered around it. So whether it's the KPIs we're talking about today, whether it's your monthly financial reports, whether it's anything from your HR department or person or company that you use, or your marketing person or company that you use, it's all about accountability. It's all about management by exception. And that's really what KPIs are intended to do. All right, so that was my little soapbox. I like to get that in, since I do have the microphone, I pretty much can control what I say. And since I can't hear any of you, I don't know anybody's yawning, so I'm going to go in my favorite directions, which is to educate and to enlighten and to explain and to create some level of humor, albeit minimal, because I am an accountant and we only, we're not known to be the funniest people in the world. However, at one point there was a pilot for a TV show called The Accountant. And, it didn't really get very far. I think they did a couple of those little test episodes, but it never made it onto national TV. I would have been watching it every week and laughing at myself, I'm sure. All right, KPI number 4, Project Overrun. All right, this one is going to look at both dollars and hours. And again, try to use the information to interpret what's going on. All right, so what we're going to start with is our definition. So we're going to look at the percentage above our budgeted cost to our actual cost. And we're going to measure that as well for our hours above our budgeted hours. Two very important metrics, and also very different. Well, you would think shouldn't they be the same? If I went over budget, it should have cost me more. Well, that's a good conclusion, but they're not often, as you'll see, in tandem with each other. They're not going to be a 10% overage in hours and a 10% overage in cost, and that's what you need to drill into a couple of different angles there. Of course, the implication is that it's going to affect your profits, and what you're going to need is a combination of budget and actual dollars and costs. Again, financial and non-financial. All right, so let's take a look at the Project Overrun on an hours basis. So we have our phases that Sally and Sam were working on, 3, 4, 5, 6, and 7, where we've looked at our time tracking system, and it's produced for us that we've incurred the actual hours in the second column. We compared that to our estimated, our budgeted, the basis on which we came up with our quote for the projects that the phases of the project that we did. And we end up with this grid showing, self-explanatory, showing that phase 1 was under budget by 5 hours, and the others were all over budget, yielding a total over budget of some 90 hours on this project, running at 105% of actual to budget. Now, there's always going to be project overruns. While we want to think that we've got this bullseye that we can hit every proposal on the money, the reality is that's very difficult to do. And that's okay. We're going to win some, we're going to lose some. Hopefully in the end, we're winning more than we're losing. And when we're losing and winning, we're analyzing. We're improving our odds of getting to the middle, to getting to that bullseye, and improving our overall performance over time. So this calculation, it's intended to give you that information. It doesn't do anything, it doesn't do a lot on its own. I mean, it's important. Don't get me wrong. You can see that. But it is purely just hours. Where some of the power comes in is when you then go forward and do the same analysis based on cost. And so, very simply, we've got the same phases, we've got the estimated costs, the actual costs, and then we're calculating our percentage under or over. And again, as expected, and I should say that while as expected, it may not necessarily be the case, as you'll see in my explanation. Phase 3 was under budget, for actual costs, whereas 4, 5, 6, and 7 all came in over cost. Now, what you might also notice is that we came in at an aggregate of almost 109% on dollars versus 105 on hours. So therein lies what should be the norm, in that there's differences between the two, and now you want to understand what those differences were. So we already talked about the hours. What's the implication here with the dollars? Why would there be a difference? Why is it 14% over budget on dollars in phase 4, but it's this is 50 hours, that's roughly 12%, a little over 12% in hours? So why is it 14% in dollars but only 12% in hours? Well, it could be that you had more expensive personnel assigned to that project than you initially anticipated. So while they all ran over, the dollars were going to run over more because, you had more expensive team members working on that project. Maybe it was something you hadn't anticipated, something ran out of scope, the complexity was different. So all of these things factor into analyzing it and taking that knowledge and using it to improve the next time you have to do a quote. Okay? All right, so we've got our action items here. Again, very similar. You need to gather all this non-financial data, do the calculations, identify the variances, and then analyze. Ask questions, get explanations, learn how to improve from all of that. So as I started to say earlier on, this art and science thing is really important to understand in the world of KPIs. Even looking at financial data is very science-driven. Those numbers, debits and credits, they always equal. There's one of each, at least one of each in every entry that you make. So you could say it's more science or mostly science. But this analysis part, this interpretation part, that's where that art comes in. Looking at them together, looking at all the employees, looking at them month by month. If you did a Google search, you would be just overwhelmed with the number of sites and places that offer information about KPIs. So it's important to sift through that and work with your professionals to come up with those KPIs that are most meaningful in helping you understand what's going on with your business. So I've outlined a number of steps here, and we're getting close. I'm going to kind of speed it through in the last slide or two because this part you can read and want to be able to answer a few questions that we see popping up. But here's a sort of an action plan of things in addition to the action steps you saw over at each one of the calculations that you can preview and take a look at. And then, well, of course, information about us and what we do. And if you want to receive any information on some of the materials that we've put together, by all means, you have a means to do that. And, Bill, I'd like to take the last 10 minutes and open up for some questions if you have any.
Dennis, terrific job. No question that there's a lot of ways people can find KPI information, but these accounting KPIs you've given us, the information on these has been tremendous. We have a couple questions, Dennis. One of them was on billing utilization. Is time tracking the only way to analyze utilization? And if so, can you point us in the right direction for finding a good way to implement time tracking?
Okay. Well, time tracking is critical to this whole analysis. Without actually instilling and getting this buy-in and getting the training of your staff to accurately keep track of their time, you're just not going to get the data that you need to be able to do this, to do these calculations. Now, part of that is something that comes from sharing with your staff the importance of this. It's not necessarily to, put them on the firing line, based on results, but to use it to understand, what's going on within the projects that you're working to better assign staff to the projects and to the level of work they're committed to. But there are a number of applications that do time tracking. There's lots of them. So I would probably first start with looking for something that integrates with your accounting, integrates with your payroll. There's a lot of efficiencies that are out there today for businesses by using technology. The cloud has just created a whole new world for us as businesses and us as consultants for our businesses, our business clients, to help them use technologies to become more efficient, to not spend as much manual labor on doing these sorts of time tracking things. No timesheets are needed anymore. Clocks are not needed. There's applications that every consultant can have an app on their phone, their desktop, their laptop, whatever tool they're using in the field to accurately track their time. That can be submitted for approval and then ultimately linked up in many cases to your payroll processor to transmit that data, and then that can feed back into your accounting program. So without getting product specific, yes, there are plenty of those things, and anyone who's billing time should be looking for that type of application.
Excellent tip. Here's another question. Should we adjust for travel time for field employees? It's billable, but it doesn't contribute to project completion.
Well, it's going to depend. A lot of times that'll be the answer. It depends. So what does it depend on? The thing it's going to depend on is how you consider that in your proposal that you put together. If you included travel time in calculating the scope of services and your pricing of it, then absolutely that travel time should be part of the calculations. If, on the other hand, your organization does not bill for travel time, that's something you absorb, then you would not be including that in your budgeted hours. So it's going to depend. I'm going to say the norm is to include it because that is a cost. The company is paying for that person to travel to the site, and so that should be considered as the way to go with regard to travel time.
Thank you. We had a question come in with regards to the annual revenues per employee calculations, and the question was, I thought this was for all employees, not just billable. So why is the calculation saying revenue per billable employee?
Well, there's two of them. The first one we talked about was, let's go back there. This first one is for the billable staff, the consultants, and we'll use the word consultant again. Just to be clear, this is the employee consultants, and our sample company had 36 of them. And so this first calculation deals with the 36 staff who are out in the field providing the services for the company. The second one is annual revenue per employee, and it is for all employees. You can see it's 45. So this company has 9 administrative personnel involved in their company, and so now we're doing a second calculation to calculate the target multiplier for including all employees. So this is where the 45 comes from. Hopefully that answers that question. Yep. Mm-hmm.
Yep, I think you got it. Okay, here's another question, Dennis. My staff is highly utilized, but our gross profit margin is still low. I don't understand.
Well, the interesting thing is utilization does not always equal profit. You can have staff working on a fixed-fee project, but they can be over budget on that project. So they're working all those hours, but at the end of the day, you're not getting more in terms of your fee. So this is when we looked at Sally's time, I guess it was more applicable when we looked at Sam's time. And I made mention that he was, I particularly like this one here. he's running at 96% utilization and your target is 80, just because he's doing 96% doesn't mean, you're just making it hand over fist with this particular employee. What it means is he's spending 96% of his time. Now, if he's entirely on time and material type of projects and you're able to collect on all those hours that you're billing for, well, I'm not suggesting that's a good long-term way for an employee to work. It's too many hours. That's one way to analyze this. But if, on the other hand, he's working on fixed-fee projects and he's going above the hours, but it's making his total percentage of hours worked to total hours 90-something 7%, you need to be questioning that, because it's the opposite that's probably happening. He's putting in more hours than are budgeted, and you're going to see your profits go down. So if you're working on a lot of fixed-fee projects and your staff is way above your target, it probably means your profit is going to be off, and not in a good way.
Excellent. Dennis, one last question. Should I count the owners as billable resources?
Good question. I did touch upon that when I mentioned when you're putting that number of consultants together, it's really based on full-time employees. So let's say you have an organization that has 5 principals, and the requirement for the 5 principals is that they spend 20% of their time doing client billable work and 80% of their time, administering the company. That's kind of an extreme example, but just gives you a good, the old 80-20 rule. And so when I'm looking at that number of consultants at 36, I wouldn't then add 5 to that, because they're only expected to contribute 1/5 of their working time towards billable work of the clients. What I really need to do is translate that or calculate that into a full-time employee equivalent. So if I've got 5 principals, each working 20% on client projects, then I would want to include 1 more in my head count, not 5 more. And that will, again, make sure that you're driving the numbers accurately. So what's the conclusion is you need to look at how your expectation is from your principals, and then translate that into a full-time equivalent and add that into your calculation.
Dennis, thank you so much. Great job today.
Excellent. Thank you very much. I appreciate the opportunity, Bill. Thank you.
I want to remind listeners of our upcoming Fridays with Vistage webinars. On September 16th at 10 a.m. Pacific and 1 p.m. Eastern, a CEO's introduction to acquisitions, creating your acquisition pipeline, Mike Zani of the Predictive Index, will help you better understand the single most important characteristics of overall executive success, self-awareness. On Friday, September 23rd at 10 a.m. Pacific, 1 p.m. Eastern, the multi-generational workforce is your company keeping pace with Jack McKelman of the McKelman Group. And on Friday, September 30th at 10 a.m. Pacific, 1 p.m. Eastern, 5 Steps to a Profitable Business with Stephen Kink, CPA, CEO of Growth Force. This has been Fridays with Vistage. I'm Bill Black, wishing you continued success, and this concludes today's webinar.